interest rates govern everything. And if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, this has not been the history of the United States to have these continued low interest rates. So,
How to Make Millions from Huge Crash Ahead for Beginners by Warren Buffett. Rule 1. Be fearful when others are greedy, and greedy when others are fearful.
if you have a temperament that when others are fearful, you're going to get scared yourself, you are not going to make a lot of money in securities over time in all probability. And that, people really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. If you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more.
Rule 2. Spend only and exclusively what you can lose. The second piece of advice that Warren Buffett gives to prepare for a possible market crash is spend only and exclusively on what you can lose. This is a general rule of investing, but Warren Buffett says it becomes much more necessary to observe during a stock market crash in times when people feel the urgent need to invest, or in times when they see the deal of a lifetime. The urge to borrow comes up, and they buy stocks with borrowed money, or sometimes they buy stocks with money that they can't afford to lose. For example, their only pull of life savings is when a market crash happens all of a sudden. Their entire lives are upheaved and are in jeopardy. It's not a wise card to play Jennifer. Again, I don't know, Jennifer, but one has to be watching, right? Warren Buffett says this on the subject. It's crazy, in my view, to borrow money on securities. It's insane to risk what you have and need for something you don't really need. You will not be way happier if you double your net worth. But why does the Oracle of Omaha recommend spending only what you know you can lose? This advice is very useful in the phases preceding the market crash. There is nothing ethical, and there is a lot of practicality. The debts made to invest must be repaid, and oftentimes quickly. However, depending on the severity of the crash, it may take too long for the crisis to end while the borrowed money is locked in, or worse yet, losing value. Borrowing to invest is therefore not sensible nor wise. This second piece of advice from Warren Buffett lends itself less towards money creation, but money securing either way. It's more money retained in your pocket. I mean, imagine if you had borrowed money to invest in the Japanese stock market before it crashed badly in the early 90s. You still would not have made that capital back to this date, and you would have a mountain of interest to deal with. Just don't invest what you can afford to lose in life. Coupled with a market crash won't make fish plating out of you. Rule 3. Trade knowing that a crash will come, but not knowing when that crash will come nor when it will end.
We have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and And the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
Thank you for watching video. Please like and subscribe Grow Up YouTube channel and follow us on social media.